A.O. Smith's Q2 2026 earnings report is out, and, well, we are looking at a quarter that missed consensus, and the market is definitely struggling to digest it.
Yeah, it's a tough one.
Right, so let's just hit the numbers cold. Headline revenue came in at $1.004 billion, which is down 1% year over year. Adjusted EPS landed at $1.03, dropping 4% from last year. And GAAP diluted EPS took a steeper hit, coming in at 91 cents.
And right after that, management immediately cut their full-year guidance, which is never what you want to see.
Exactly. They pulled down the top end of their sales growth projection to a pretty tight 2% to 3% range, and they squeezed the adjusted EPS guidance to $3.70 to $3.85, basically clipping off that previous $4 upper bound.
Which explains the stock reaction. Unsurprisingly, we saw significant volatility right out of the gate as Wall Street tried to, quickly price in that guidance cut.
Yeah, I mean, the initial sell-side reaction makes total sense when you just look at that surface-level stagnation.
It does. But, if you stop your analysis at that consolidated billion-dollar revenue figure, you are going to completely miss the actual mechanics of what is happening inside this company.
Right.
Because those top-line numbers are heavily, heavily masking a severe geographic divergence in their operations.
Which is exactly our mission for this depth dive today, because I mean, when I see free cash flow surge by 67% in the exact same quarter that net earnings drop, my immediate thought is that we are looking at some aggressive financial engineering.
Oh, absolutely.
So today we are opening up A.O. Smith's Q2 ledger for you. We need to figure out how booming North American boiler sales and massive working capital adjustments are basically working overtime to hide structural demand destruction in China, along with some really heavy margin pressures from commodity costs.
You really have to split the map to understand the unit economics here.
Yeah.
I mean, you cannot value the North American cash cow using the same multiples as the Chinese operation right now.
No, definitely not.
The macroeconomic environments are just completely divorced from one another at this point.
So let's start with the primary engine then, which is North America. This segment actually saw top-line growth. Sales increased 5% to $820.5 million.
Yeah, and organic growth contributed 3% of that. And they also picked up a solid $16 million revenue bump from that January acquisition of Leonard Valve.
Right, let's touch on Leonard Valve for just a second. They specialize in water temperature control and safety valves. And I mean, adding a $16 million bolt-on to an $820 million segment isn't really moving the needle on its own.
No, it's pretty small.
But it signals a broader strategy, right? Acquiring these higher margin specialized components to integrate into their commercial ecosystem.
Exactly. It's a classic margin accretive bolt-on play.
Yeah.
But honestly, the absolute standout metric driving that North American growth wasn't the acquisition at all.
Right, it was the boilers.
Yeah, it was a 21% organic jump in commercial boiler sales.
Yeah.
I mean, a 21% surge in a mature industrial segment is just staggering.
It's math.
And management attributed this to a combination of strong underlying commercial demand, plus, the carryover effect of pricing actions they implemented in previous quarters.
Well, I look at that 21% boiler growth, and I instantly see a barbell portfolio.
Okay, how so?
Well, on one end, you have this high-growth commercial asset just sprinting ahead. But on the other end, you have their reliable blue-chip asset, the residential water heaters, which are currently lagging. They are just bogged down by a really sluggish U.S. housing market.
That is a great way to frame it.
And it's fascinating because, residential water heaters are supposed to be immune to a lot of this macro noise. They're overwhelmingly a replacement-driven product.
Right, you don't really have a choice.
Exactly. When your water heater floods your basement, you don't go check the Federal Reserve's dot plot to see if interest rates are favorable before you buy a new one. You just buy the water heater.
You'd think so, yeah. That replacement thesis is usually bulletproof. But we are actually seeing the absolute limits of its resilience right now.
Really? How much can it actually slow down?
Well, even replacement demand softens when the broader residential construction and home turnover markets freeze up entirely. I mean, when existing home sales plummet, which is exactly what the U.S. housing sector is experiencing, you lose all that replacement volume that naturally occurs when people, prep a house for sale.
Oh, sure. Or when new buyers move in and immediately upgrade the old appliances.
Exactly. So homeowners who aren't moving are just choosing to patch and repair older units rather than replace them. They're stretching that replacement cycle by an extra year or two.
So the commercial boilers are effectively carrying the residential water heaters on their back right now.
100%.
Well, let's look at the profitability side of this North American barbell, because this is where the operating leverage story gets really complicated.
Yeah. Ta-da.
Despite that 5% top-line revenue growth, segment margins actually dropped to 21.6%, down from 25.4% last year. Now, if we strip out the $22.6 million pre-tax restructuring and impairment charge related to their water treatment business, the adjusted segment margin is 24.4%.
But even on an adjusted basis, those margins are compressing.
Right. And management flat out blamed higher steel and input costs for completely eating up the benefits of those pricing actions we just talked about.
It is the defining operational squeeze for industrial manufacturers in this current environment. I mean, they push prices up, but raw materials, specifically steel, which is obviously the heaviest component of a water heater, went up faster and harder.
See, here is where I want to pressure test their pricing power. When a company with A.O. Smith's dominant market share takes a margin hit strictly because steel prices spiked, we really have to ask if this is a structural risk to their operating leverage. Or is it just a temporary timing mismatch?
That's the key question.
Because in my view, it exposes a vulnerability in how fast they can actually pass costs through their distribution network.
You are hitting on a really critical lag effect in industrial pricing. Look, A.O. Smith undoubtedly has pricing power. They basically operate in an oligopoly in North America.
Right.
But operating leverage is a double-edged sword when input costs are this volatile. When steel prices spike, A.O. Smith is buying that expensive steel immediately just to keep the factories running.
But they can't raise prices that same day.
Exactly. It takes months to announce a price increase, negotiate it with your major distributors, and finally see that higher price reflected in recognized revenue.
So the costs hit the income statement today, but the revenue bump from higher prices takes, what, a quarter or two to catch up?
Yep, pretty much.
So if commodity volatility remains high, they are going to constantly be playing catch up. They are essentially running hard just to stand still on profitability.
Which is exactly why relying on multiple rounds of price hikes to defend margins is exhausting for the whole supply chain. Eventually, distributors push back or, you invite cheaper international competition to undercut you.
Yeah, that makes sense.
It is a temporary headwind, assuming steel prices eventually stabilize. But if we enter a super cycle of commodity inflation, that lag effect will just consistently compress their margins.
Wow. Okay, so if North America is running hard just to stand still, the rest of world segment is actively drowning.
Oh, it's brutal over there.
Yeah, moving from a temporary margin squeeze in the U.S. to a massive demand-side problem overseas, the numbers are just grim. This segment is overwhelmingly dominated by China, and sales plummeted 19% to $194.9 million. But honestly, that headline number is actually sugarcoating the reality of the demand destruction.
Significantly sugarcoating it.
Mm-hmm.
When you strip out a $6 million favorable currency translation benefit, sales in China actually dropped a staggering 28% in local currency.
A 28% drop in unit volume, that is a massive structural failure for a manufacturing footprint.
It really is.
I mean, we are seeing the downstream devastation of the Chinese property crisis in real time. We just talked about how the U.S. market relies on replacement demand. The Chinese market for water heaters and water treatment systems is fundamentally different. It is heavily indexed to new housing construction.
Right, it's completely tied to new builds.
So when Chinese property developers run out of credit and they halt construction on unfinished apartment blocks and consumers just stop buying, the demand for A.O. Smith appliances falls off a cliff. There is simply no replacement market big enough over there to absorb that loss of new construction volume.
And that perfectly explains why the margin profile over there completely collapsed. Segment margins were slashed from 10.5% in the second quarter of last year down to 5.2% this quarter.
Cut in half.
Literally in half. When you lose 28% of your unit volume, the fixed costs of operating heavy manufacturing plants usually crush your profitability entirely.
So the fact they didn't go negative is almost surprising.
Right. The fact that they maintained a 5.2% margin tells us management is aggressively pulling every single operational lever they have. They're likely cutting factory shifts, halting discretionary SG&A spending, and just shrinking their footprint strictly to keep the segment cash positive.
And this brings us to a very specific, heavily loaded piece of management commentary. CEO Steve Schaefer explicitly stated they are managing through a significantly weaker market environment in China. And then he announced they are undergoing a strategic assessment of the China business.
Those are heavy words.
Two very heavy words for a CEO to drop into an earnings release. When I hear strategic assessment, I don't think they are just tweaking their local marketing budget.
Not at all.
I read that as a formalized signal to Wall Street that they are totally done waiting for Chinese housing stimulus programs to finally materialize.
It is the ultimate corporate finance green light for speculation, which means all options are on the table. Management teams simply do not use that phrase lightly.
Yeah.
They are actively taking control of the narrative by acknowledging that the structural headwinds in China are not just temporary macroeconomic blips.
So let's game out the scenarios here. What does a strategic assessment actually result in? Because a complete exit from China seems highly unlikely and, frankly, incredibly messy.
Oh, a complete exit is the nuclear option.
Right. You have massive physical assets, complex supply chain entanglements, and huge severance liabilities. But they clearly can't maintain the status quo.
You're right, it's prohibitively expensive and complicated to just pack up and leave. The more likely scenarios involve some sort of structural de-risking.
Like what?
That could mean drastically shrinking their physical manufacturing footprint, or maybe divesting underperforming product lines, or very possibly moving toward a joint venture.
A joint venture.
Yeah, finding a local Chinese partner to take on the capital risk and the operational overhead, while A.O. Smith simply licenses its brand and technology. That would allow them to maintain a presence in the market without constantly bleeding capital.
It effectively transitions them from an asset-heavy operator to an licensor in the region. That makes a lot of sense.
It's a very common playbook for this kind of situation.
So we have margin compression in the U.S. due to steel cost and a near total collapse of unit economics in China. If you stopped analyzing the earnings report right there, you would just assume this was a disastrous quarter for the balance sheet.
You would. But this is exactly where the narrative completely inverts.
Right. The balance sheet and the cash flow statement tell an entirely different story than the income statement this quarter. Let's look at the liquidity, because this is honestly the primary reason the stock isn't in absolute free fall today.
It is the saving grace.
Year-to-date operating cash flow spiked 42% to $254 million. And free cash flow surged 67% to $233 million.
That is just a massive jump.
It is. We have net earnings down year over year, yet free cash flow is up 67%. When I see cash flow decouple from actual earnings that aggressively, it points directly to working capital management. They are financially engineering this quarter by squeezing cash out of their own operations.
The mechanics of it are textbook defensive management. Look, when top-line growth stalls, you turn to the balance sheet. They are likely running down their existing inventory instead of buying new raw materials.
Right.
And at the same time, they are accelerating the receivables, so getting customers to pay faster while strategically stretching out their payables to suppliers.
So they hold on to their cash longer.
Exactly. If you delay paying for your steel by an extra 30 days, but you collect cash from your distributors 15 days faster, you generate a massive wave of free cash flow without selling a single extra water heater.
It is the classic sponge analogy. You squeeze the working capital sponge and a flood of cash comes out. But my major pushback here is sustainability.
Yeah, you can only squeeze it so much.
Right. You can only bleed down your inventory so far before you literally run out of products to sell. And you can only delay paying your suppliers for so long before they just cut you off.
Yep.
A 67% jump in free cash flow is a fantastic cushion for this quarter. But if underlying unit volumes in U.S. housing and Chinese construction don't recover, say, by 2027, that sponge will be bone dry.
That is the exact risk metric that you need to model out. Working capital benefits are almost always a one-time structural adjustment. Once the balance sheet is optimized, cash flow has to perfectly mirror operational earnings again.
It has to catch up.
It has to. If the operational earnings are still under pressure next year, cash generation will just fall off a cliff.
Well, right now they have the cash, and they are allocating it aggressively to reward shareholders and defend their EPS. Management deployed $162.4 million to buy back roughly 2.6 million shares in the first half of the year.
And they aren't stopping there.
Nope. Because of that working capital cash waves we just discussed, they hiked their full year 2026 share repurchase target by 50%. So they moved it from $200 million all the way up to $300 million.
It is a phenomenal way to manufacture earnings per share value when your organic top-line growth is stagnant. By shrinking the denominator, the total number of outstanding shares, the earnings they do generate are spread across fewer shares.
Which artificially supports that adjusted EPS guidance of $3.70 to $3.85.
Exactly.
It is a mature cash cow playbook, and their leverage supports this strategy perfectly. The debt-to-capital ratio is sitting at a very healthy 25.7%, with $637.5 million in debt compared to $181.3 million in cash.
That's really manageable.
Very. And the report notes that their leverage only ticked up year over year strictly because of the term loan they took out to acquire Leonard Valve. They are not over-leveraged at all, which gives them the dry powder to keep buying back stock or to weather a prolonged downturn in residential construction.
And having a fortified balance sheet is essential right now because the forward-looking risks they flagged in this report are definitely mounting.
Let's talk about those.
Well, beyond the U.S. housing and commercial instability we've already covered, management explicitly highlighted international tariff policy changes, ongoing steel price volatility, and secular trends toward decarbonization.
Tariffs are huge for them.
Huge. For a company manufacturing globally and sourcing components across borders, a sudden shift in tariff policy can absolutely wreck supply chain economics overnight.
The tariff risk is definitely an immediate headline-driven threat. But looking at the secular trends, the decarbonization warning is what really caught my eye.
That's sure.
Let's bring this all together and distill the core takeaway for everyone listening. A.O. Smith's Q2 is fundamentally a tale of two continents. In North America, you have incredibly strong capital engineering and booming commercial boiler sales that are actively masking the underlying unit volume softness in residential water heaters.
Yeah.
And meanwhile, overseas, you have a severe market deterioration in China, forcing management to formally reassess their entire operational strategy in the region.
It is a masterclass in utilizing balance sheet strength to navigate operational weakness. The critical factor for investors going forward is monitoring whether those operational weaknesses eventually drag down the cash flow once those working capital levers are fully exhausted.
Which brings me to a final thesis for you to mull over regarding those risk factors. The earnings report explicitly highlights the company's potential inability to respond to secular trends toward decarbonization and energy efficiency as a major long-term risk.
Yes, it's a huge secular headwind.
Yet the absolute main engine of top-line growth for A.O. Smith this quarter was a 21% surge in gas boilers. Think about the contradiction there.
It's quite the paradox.
Is A.O. Smith's current high-growth driver actually a long-term trap in an increasingly decarbonized world? Or are these highly profitable gas boilers simply providing the necessary cash bridge to fund their transition into future electric technologies?
I mean, when a company's biggest growth engine is at direct odds with the stated secular trend of the entire industry, understanding how management navigates that transition will dictate their valuation for the next decade.
We will leave you to run the numbers on that one. Make sure you follow the show to get your daily no-fluff earnings coverage. We dissect the filings so you don't have to.